And welcome to Lecture 3, Multidimensional Forecasting. So what is this lecture about? I know that title sounds a little screwy. It might not make sense off the bat, but you'll realize here in a second why it does make more sense than ever. First off, trading direction, just identifying a simple direction is just not enough in this game. So we always hear, are you bullish or you're bearish? And that's really just not enough in the game of trading and investing. There's so many other considerations involved on top of whether something is going up or down. We have time frame. How long will it take to go up or down? We have magnitude. Is it going to go up a lot, or is it going to go down a lot, or just a little bit? We have volatility. Is it going to be smooth sailing, or is it going to be extremely rocky and volatile with lots of ups and downs? What's the risk reward on the play, right? Is it extremely risky and has a lot of upside as well, or is it very low risk with a ton of reward? And finally, correlations. How does that position, or how does that trading theme, or how does that trading idea interact with the rest of your portfolio? So the game is much more complex than bullish and bearish. So we're going to go through each level of forecasting. And there's 5 levels, and we're going to start with level 1, and you're going to see how each level gets more and more in depth and qualifies it with more specificity each time we dig lower and lower. So level 1, this is the thing that we hear on TV all the time. Bloomberg, CNBC, they're coming up and say, what are you thinking about GoPro this quarter? And I'm a bull. And then the other guy next to him says, no, I'm a bear because XYZ. And this is the classic stock analyst rating that comes out of the big investment banks. It's the most basic forecast, and it's also the least valuable, but it's like candy. It's what people want to hear. Hey, you bullish or you bearish? It makes for a good TV bite, a good sound bite, but it doesn't really help us that much. So back in the day, when I first started out, I would succumb to these level 1 forecasts. And if someone were to come up to me and say, gold's going up, I would actually get excited about it. I would go out and figure, okay, do I need to buy GLD? Do I need to go and buy the gold futures? What do I need to do to capitalize on it? This is some type of source or newsletter or TV show where this pundit that sounded smart is saying gold's going up, and that meant that I needed to go buy. But as I learned and got more seasoned in the game, I realized that's not even close to enough of what you need to fit into a proper trading and investing process, because there's many more questions that impact the trade than whether or not gold's going up. So I wrote these questions down here. When will gold go up? How much is it going to go up? What is the chance of it being wrong and it going down? And then what's the risk reward on the trade? What are we looking for? So these are all questions that aren't answered by something as simple as gold's going up, and beginners have trouble understanding this. And that's why people starting off, they want the quick, easy picks. They want, hey, buy this, buy this, buy this. This is going to do well. Stay away from these. But you need many more qualifiers to really make the trade actionable and safe. So this is a funny concept if you think about it, but with enough time, every asset's going to be going up and down. Okay, sometime in the future, gold's going to be higher than it is today, and it's also going to be lower than it is today. So it's very likely that gold trading at 2,000 or gold trading at 3,000, that given enough time, that's going to occur. But that doesn't really help us. And to another point here, gold can actually be bearish in a short term, but bullish in the long term. So assets can have different directional biases depending on the time frame. So that's why it's so important to qualify it with many more levels. Just saying, hey, something's bullish or bearish doesn't really help us. So take this chart of gold here. We can see that it's trading at 1267 in this chart. And now if someone told me if it was bullish, how does that help me? Right? If we were to extend this chart out to 2024, like I have here, gold could potentially look like this. Right? And then it spikes up and spikes back down. So eventually along this continuum, gold went up, but it also went down. So unless you qualify it with a time frame, if someone just say, hey, gold's bullish, it's going to hit 1500, well, that's great there. But what if you don't take your profits there and it falls and then it hits it again? So given enough time, gold will hit 1500. We just don't know what it will look like. And do we even care if gold will hit 1500 if it were to take, say, multiple years? So what if something happened like this where gold, downtrended and hit 800 and then went up to 1500? Well, yes, the bullish forecast was correct with enough time, but it took many, many years for it to play out. So in 2016, you were still underwater in 2020, and you didn't even get to your target until 2024. Do we really care? Would you really care if gold actually hit your target with that amount of time? Now, a level 2 forecast, it adds in this time frame. And so this is an extremely important qualifier. So this is an example of a level 2 forecast would be gold will trade higher within the next 6 months. So this is a lot better, and it definitely helps us, but it's still missing a lot of information. Level 3, it adds in probability on top of time frame. So an example of a level 3 forecast would be something like there's a 60% chance that gold trades higher within 6 months' time. So that's useful as a signal for us, but it still says really nothing about risk. What's our downside? It says, hey, gold's going to be higher. It's at a 60% chance that it's going to be higher, and it's going to happen within the next 6 months. Okay, now that's something actionable, but it still isn't quite there for at least defining a trade in the way that we like to define it. So 4 is what we would consider a tradable forecast. And we get to a level 4 at MacroOps by using price action and technicals. And an example of a level 4 forecast would be there's a 50% chance that gold will trade at $1,400 an ounce without ever dropping below $1,000 an ounce in the next 6 months. So that's a tradable forecast, right? We got targets, risk points, direction, time frame, probability of the move. That's really all we need to actually make a trade. So now if you look at this chart of gold, right, I put in some fake stops and targets here, but if we were to purchase gold here and said, hey, we expect this to hit our target of 1440 before it hits 1167 in the next month or so, well, then we have a tradable forecast because, we could get into this trade, and if it trades down, we know what our risk is. If it trades up, we know exactly what our target is. And if it just goes sideways and doesn't hit any of these, and that 6 months time elapses, we can cut the trade. And so the forecast is defined. We're not in purgatory of, staying in this trade forever because we never qualified it with a time frame or a bracket. So if we don't have any of these brackets or we don't have a time frame, we just stay in this trade and gold can do this, right? And we could just be in this trade forever in perpetuity. So having that specific and that deep level of forecasting helps you set up that trade correctly. And then finally, there's actually a deeper level of forecasting that's extremely complex. It's not necessarily needed to execute trades, but it gives insight into advanced trade management. So this is how the trade's behavior is going to play out. And level 5 adds in an estimate of the path forward to the target or stop. So, are we expecting to travel in a straight line to the target, or are we going to have a bunch of deep retraces? So are we going to have, is the stock just going to take off and run straight to, our target, or is it going to look like this and we're expecting that? Right? These are two different trades, but sometimes we were able to estimate what it could look like. All right, and then two other things, grinding slowly or moving quickly. So grind slow is, just a little bit up every single day, or do you expect to spike up? And again, the types of charts and the types of paths can largely depend on what the price action in the chart is saying to us. And whether the thing has high volatility with an expanding range or low volatility with a tight range will really help us manage the trade and give us expectations on how to size the position. So here's an example of level 5 forecast. There's a 50% chance that gold will travel in a low volatility trend up to $1,400 per ounce without ever dropping below $1,200 an ounce in the next 6 months. And this is about as specific as we can get. short of calling, every day's move, which is a fool's errand. This is about as specific as we can get. So let's say we had this particular situation again in gold, and we wanted to get into it, and we set our level 5 forecast expects us to purchase here, and we're going to have a nice smooth trend up to the target at 1400. And if we don't get any type of smooth trend up to the target, then it's likely a busted trade. Okay, so this lets us manage it appropriately as it plays out. So if we have a lot of volatility, then we're likely to cut the trade, and we have a base case. We have a case that we're looking for, an ideal scenario, which is a slow trend up to 1400. So without understanding price action or a chart, it's extremely difficult to develop these high-level forecasts because funnies alone can't cut it. Funnies can tell you what the potential and direction of a trade, but they're never going to be able to tell you the timing or how to define the risk and the profit targets and the brackets that you're shooting for. So price action turns your fundamental assumptions into an executable trading campaign through this multi-dimensional forecast, and you get each level deeper and deeper and deeper that helps you qualify and be very specific with what you're looking for out of the trade. And that's why knowing how to read a chart and price action is so invaluable to the trading process.